Hello and welcome to the Investment Magazine CIO Series. I'm Simon Hoyle, reporter at large and editor of Retirement Magazine, and I am delighted to be joined today by the Chief Investment Officer of the $170 billion UniSuper, John Pearce. John, great to see you, and thanks very much for coming in.
Absolute pleasure.
Now, when we were setting a date and a time for this podcast, we had to look quite a few weeks ahead to find a slot in your diary. Looks like it's pretty full. Is the job of being a CIO busier today than it was when you started in it?
I wouldn't say that. We just deal with different things. Right? When I started, we were very much in building a business phase, right? So we had no funds under in-house management. So building all that capability with people, with systems and processes and getting your approvals, etc. That took up a lot of my time. And now we're fairly mature in terms of our corporate, where we are in our corporate life cycle. So it's just busy with different things.
So what would you say takes up most of your time now? How much of it is involved in managing the business, if I can put it that way, and how much is actually hands-on investment stuff?
It's pretty much the latter now. As I said, we're in a pretty mature stage of our corporate life cycle. And I'm actually surrounded by people who've almost, grown up with me. And we've built this together. And I don't need to manage them; they manage themselves. So it's good. I can do the things that I enjoy doing, which is just reading a lot about the world and what's impacting our investments and opportunities and risks, etc.
So we'll come to the issue of how you manage a team and how you deal with very talented and very ambitious individuals as a team. We'll come to that in a little bit, but I'd like to spend a bit of time asking about your qualities as a leader and what you bring to the table. You say you've got a mature team operating under you. That doesn't mean that you're superfluous. So what is it that you bring to the table?
I always find that you're better off asking people that I lead that question, right? But anyway, you've asked the question.
They're not here today, so I've got to ask you.
That's right. I always, when you describe, what you are as a leader, well, you should ask people that I lead. Look, what do I think, what might differentiate me from other leaders? I tend to consider myself more of a player than a coach, as a captain than a coach. So it's more lead by example than, coach from the sidelines. So I guess that's one of the distinguishing features. I tend, I'm a big proponent of empowerment and accountability, right? And these, it's really important because I think, leaders and boards and committees, they get the accountability thing pretty easily, right? It's easy to hold people accountable for things. Where I think a lot of leaders struggle is the empowerment side of things. Letting go, getting out of people's way. Setting the goal, etc. But then really, how you get the goal, it's really up to you. Empower people to do that. So I'd like to think that I do that. All right. And I think the other thing about leadership, I think we, getting the communication right. I think there's a sense with people that, there's never enough communication, you can never have too much. I believe you can. I actually do believe you can. And it's getting it the right balance. Talk when you say something that it's worth talking about, right? Tell people where you're going, let them know what they have to do and give them some feedback as to how they're going. Once you do that, you've pretty much got that as 90% of the deal.
So you've touched on an issue that I did want to ask you about, which is how do you avoid a situation where you're the guy who's been in that position for a considerable period of time and you're not a blocker to the ambitions or the ideas or the things that your team want to get done?
Well, look, the way we structure things is that the senior portfolio managers and heads of asset classes have got their own portfolios and their own benchmarks. And, I would never tell them what to buy or sell or how to run their own businesses. Clearly, I've got my own portfolios and own investment objectives to reach. Obviously, I get very heavily involved in the asset allocation side of things because ultimately it's your asset allocation that will drive a lot of your the outcomes. But I think we've just got the division of responsibilities pretty clear, and that's the structure itself lends itself to that accountability and empowerment that I've been talking about.
So let's talk a little bit about the sort of formal way you interact with the team. You have the asset allocation decisions that are made across the team. Tell me about the process that leads to that.
Yeah, so once a month we have an asset allocation committee, but I might just take a step back because our asset allocation committee is comprised of the head of asset allocation, which is a really bright guy by the name of Nick Footnow. But that's it in terms of full-time involved with asset allocation. The rest of the committee is actually some of the heads of the asset classes, equities, fixed interest, and then you've got a couple of really bright young people that can also add value. Now, this is, once again, I think it's a little bit different from a lot of other funds that will have a very specialized, large team just focusing on asset allocation. We like having everything integrated in the business. It's one of the more interesting things that, what the head of equities actually does is get involved in the asset allocation. So once a month we meet formally with papers, et cetera. Then every Monday afternoon we'll also just get together for a quick call. Look, it might take 2 minutes. We might actually cancel the meeting depending on what things are going. So I'm all for, getting rid of meetings if you don't need them. So I cancel more meetings than we actually have.
That's what I like to hear. So you've got a team of roughly 75 individuals now. They're all smart, intelligent, motivated individuals. How do you ultimately, though, I mean, notwithstanding that, any team is only as good as its weakest player or its weakest link. So what sort of eye do you cast over the team in terms of, when I say performance, I don't mean necessarily investment returns. I mean their performance as individuals, as team members, and in their specific roles. How formalized is that process?
Not very formalized, And once again, I leave a lot of the day-to-day team management to, my team. Right, I don't get involved in the managing of their teams. They're closer to the people. They understand the different attributes that individual team members have.
So the hiring or firing of an individual in the team would be down to the head of the asset class?
Absolutely. Yeah. All right. At a senior level, I will get involved in an interview at the very late stage. If it's got, that person has been through 4 or 5, I'm really just checking cultural fit.
Yep.
More than anything. People that they've got through 5 or 6 interviews with senior people, they've got the technical skills, they can do the job. I'm more interested in cultural fit. But, the more junior stuff, I won't get involved with the interviews.
Fair enough. Culture's an interesting question, an interesting issue. How would you describe the culture that you're trying to nurture or foster inside the organisation?
Look, I'd like to think it's, I'd like to think it's a very open culture. I'd like to think there's, that people feel that their job is useful. Okay, so if you always think, the best advice you can give a young person, right, is just try to be useful. So with 170 billion, 75 people is not a big team, and bear in mind that covers in-house asset management, external. All right, we've got quant strategies, we've got fundamental strategies. So so I can put my hand on my heart and say that everyone on the team is doing a really useful job. So that's the culture that I want to have, that people genuinely feel gainfully employed.
Gainfully employed and engaged, I imagine. Yeah, because it must be difficult to keep them interested, keep them engaged, or do you find that they are kind of self-motivated in that sense? Look,
it varies. Okay. And you mentioned that a team's as strong as its weakest link. We'll question that, right? Because we've just got to accept the reality that all people aren't equal. We want to have equal opportunities, right? But we can't have equal outcomes because people have different talents, right? And in any team, in investment teams, we use sporting analogies a lot, right? But there are some really key players, right? Like in any team, there are key players, and you make sure that you those key players, right, have got, they're motivated, they're challenged, right, they're rewarded, etc. And that's what I tend to focus on. It's like, I think once again, a sporting analogy is, the successful footy teams, they focus on having a really good spine. All right. And once you have good spine, all right, then you've got other players, right, that can actually, they work off that spine, and that's what creates success.
One of our global events recently, the Fiduciary Investors Symposium in Singapore, one of the presenters there, the out of category presenter there, was Usman Khawaja, the former Test cricketer. Mm-hmm. He expressed the idea that in any team, the captain is also the best player in the team. You've described yourself as the captain of the team. Do you also consider yourself the best player?
No, you'd have to. And we're playing a few different games too. All right. So, the best player in fixed interest is going to be our head of fixed interest. I'm not a better player in fixed interest than him. All right. The best player in equities is our head of equities. I'm not a better player than her in that game.
Yeah. Okay. That's extremely diplomatic of you, John. That's good. One of the hardest decisions for the leader of any team is knowing when to step away. I'm not suggesting that time's necessarily close for you, but at what point do you say, okay, this team needs refreshed leadership and it needs a refreshed leader and it's time to hand over?
Yeah, look, I think, there's no, I don't think there's any formula. I like to quote Jamie Dimon on this one, so I'll attribute this because quite often you hear people say, "Oh, when I lose energy, etc." He didn't use the word energy; he used the word intensity. So it's where he'll quit when he loses his intensity. And if you see Jamie Dimon, there's no way in the world that guy has lost any intensity, right? So, and I like to think that I'm the same way. I haven't lost any of my intensity. I've still got a very competitive streak, but the day I lose my intensity, I think that'll be the time to hang up the boots.
It's possible somebody will tell you that as well, I imagine.
Yeah, I don't know. For these sort of things, you're probably relying on your investment committee, your board, etc. It might not come from below. I'd like to think that I've made enough. I've got some pretty good relationships with people that report to me that can pull me aside and say, "Hey, mate, you notice you're not as engaged as you used to be." But hopefully that I have the wisdom to know when the day is the right time.
That's interesting. Maintaining intensity. I mean, it does take energy to maintain the intensity. I know that you disputed or prefer to use the word intensity rather than energy. What is it that keeps the spark alive for you? You've been in and around markets, a significant part of your life. How do you avoid the sense that, here we go again? How do you keep the love alive, if I can put it that way?
Well, I just don't know of any job that could be so interesting. If I wasn't doing this job, and this goes back to university days, right? I'd still be reading all the financial press, because it's just really interesting. What job can you do where pretty much anything that happens in the world is somehow connected to an outcome, right, that you're looking at, right? So now some of it's minor, and there are a lot of things that don't really matter, but you've got to be look at a lot of things to find out what matters. Okay, so I think that's really what is the intellectual stimulation of knowing that there are so many things that are happening in the world that are connected to the outcome, and it's just I think that's really that keeps people fascinated and curious.
How do you keep the balance between being intense, being focused, being energetic and driven in what you do, and the risk of burnout, the risk of going too far in that direction maybe, and having it have a detrimental effect on yourself?
Well, we can talk about work-life balance and all those sort of things. Let me propose to you that no successful person, okay, is totally balanced, okay, in terms of people who've reached the peak of, their careers or sport, in sport or business, etc. You've shown me someone that's hit the top of what and I'll show you someone that's made sacrifices, right? So we got to accept that if you want to get to the top of anything, you've just got to make some sacrifice, and that means at time the tank's pretty low, right? And you can be running on empty, but it's cyclical. You'll be able to. There'll be time to refill as well.
Yeah, you've had a pretty interesting career. You spent a long time at CFS. You had a stint in China as well.
Mm-hmm.
Tell me a little bit about what each of those experiences, each of those roles, brings to inform you in the role you do at UniSuper.
What's the overarching rule? Okay, is that there isn't one. There's no formula for success, right? There's absolutely no formula. And if there was a formula, everyone would just apply it, and you'd lose any advantage. Okay, so the secret to good leadership is adaptability, right? So where you are in terms of your own corporate life cycle, where you are in terms of the team you got around you, where you are in terms of the external environment, right? You just have to adapt, right? Working in a retail, this was the highest performing, largest retail fund at the time, was completely different to working in a large profit for members fund, and you've just got to adapt your style.
Well, so in a sense, you've created a blueprint. In the sense that, how long ago did you join UniSuper?
17 years now.
17 years. Mm-hmm. And what was the size of the fund then?
It was about 30.
Yeah, right. Mm-hmm. So it's gone from 30 to 170. Over 17 years, you've internalized a lot of the asset management. You've grown the internal team to 75. There was no one there before you who had done any of that. You've done this stuff as, I hesitate to use the term pioneer, but I think you know what I mean. You've figured out how to do this on the fly as the fund has grown and as how the superannuation industry has grown around it. So to what extent have yourself and your peers and your colleagues who have been in similar roles for similar periods of time created the blueprint for the generation that follows you?
Look, I don't know. Time will tell, who follows what blueprint, because I know that others in the industry have not followed the same path that we have. What's the path that we have followed that I think works in a lot of situations is, I call our business strategy was one of logical incrementalism, right? So, and that means we never went for a big bang approach. We never actually had, I never went to the board and said, here's the light on the hill. In 5 years' time, we're going to be managing 50% of our, funds in-house, et cetera, across all these, it was really small steps quickly, right? And, every 3 months we go to the investment committee and say, this is the strategy that we're going to have you look at and say, well, that makes sense. That's sort of, a logical incremental step from, the base that we've set. So I think, if there was one sort of lesson that, may be repeated, from my successes, or it'd be that.
I guess the point you made at the outset was that the growth, the creation, the sort of almost entrepreneurial part of the growth of the fund is not exactly over, but it's certainly peaked.
Oh, it's plateaued. Yeah. It's definitely plateaued. Now, having said that, we've just employed a really bright young guy, and we just for the first time put in we've established a new global equities portfolio, which is it's exciting new strategy. So I'm not saying that the period of innovation is over, but it's that sort of really sharp growth that we had in the formative years has certainly slowed down. Bear in mind, AI is a game changer. All right, so what our business model looks like in 2 years' time, I'd suggest is going to be very different to what it looks like today.
So you're asking my questions for me here, John. This is making this very, very easy. But I wanted to talk to you about AI from two different directions. You've spoken a little bit about the investment opportunities in AI. You sort of see them as an adjacency to sort of the AI thing. So let's talk a little bit about that. And then let's talk about the application of AI to your own investment operations. Where are the big opportunities that you're seeing in that space as an investor at the moment?
Look, if you look at the data center build out, for example, there's a whole lot of adjacencies. The most obvious one is the first order one. You buy NVIDIA, right? And it's hard to work out a scenario where NVIDIA doesn't win. Right? Frankly, right? It's just a matter of valuation. And then you've got a whole of other adjacencies, cooling systems, power, etc. The data center build out itself, we're not getting involved directly. We've got big stakes in NextDC and Goodman, but in terms of unlisted investment, we're staying out of that. Look, it's not so much the capital intensity per se. It's the fact that these platforms are going to keep coming back, and coming back and coming back for capital after capital. They are going to be so capital hungry, right? I don't think you're missing out by not participating yet. And at a project level, we're not that keen because you don't want to own a data center that's been built today in 7 years' time. If you can't flip it, that thing's already depreciated. After 2 or 3 years, who knows what the technology is going to be. So, but look, in terms of there's the bigger opportunity, the spin-off effects to the broader economy are enormous. We talk about the $650–700 billion investment next year by the hyperscalers, and everyone does get concerned about the return on investment there. But one company's spending is another company's revenue. All right, so you've just got to work out where that money is flowing.
Over your career, though, you've experienced firsthand a bunch of cycles, booms, busts, the whole thing. What's different? I mean, this time it's different is not something you want to hear anybody actually say, but what makes this perhaps, different?
Look, I think this whole environment that we're in now, I'm starting to wonder whether, we've seen the death of recessions, where, we're in an era of permanent stimulus. Now, why do I say that? It's almost like a global societal thing that we've got very little tolerance for pain, right? And whenever you see the slightest hint of a recession, right? Now, I'm not talking about recessions that are generated by, external exogenous shocks, like COVID, for example. Recessions that are engineered by central banks, etc. Whenever you see the slightest hint of an economic slowdown, what happens? The central banks slash rates, the governments start printing money, etc. You got quantitative easing, etc. So
it's pumped up again.
We could be in this era of permanent stimulus, right? And it's just by the dips. Now that's a very big picture answer to your question. In terms of the actual data center build out and AI, what's different this time? Well, look, it might end soon, but but it'll end one day, but it's not soon, all right? It's not soon because the scaling laws are still working. And what do I mean by that is that, the newer chips that have come out, all right, the compute efficiency is improving. So it's rational for the hyperscalers to keep investing.
So Moore's law holds at this point.
Yeah, exactly. Now, and it's and that also, so it's Microsoft has to keep spending, right? If Google's spending, and even if the others stop, and the scaling laws are working, well, Microsoft will keep spending because they're going to get a benefit from it. Similarly, at a corporate level, right, as users, where the risk of underspending now feels greater than the risk of overspending, right? Because if all your competitors are doing this, and hey, there's something in this, well, you've got to keep spending. So, I think this is going to go on for some time until those scale laws, stop applying, right? We're going to keep spending.
So that makes sense, but at some point, the technology that is being developed and redeveloped has to be deployed. It has to be adopted by business broadly for the investment to pay off. So it has to have an impact on business, a positive impact on business for it to be taken up at a widespread. So in your own, perhaps slightly modest way, how is UniSuper actually employing AI in its own business?
Yeah, and I don't want to exaggerate because I think there's a lot of exaggeration that goes on in terms of how companies are deploying AI. And by the way, when you ask for examples, quite often they'll give you examples of just just normal technology improvements. That's not AI. Okay, that's you're actually just automating something. So we are not looking at investment-wide solutions at this stage. What we are doing though, we're subscribing to everything. We've got AlphaSense, we've got Bloomberg, we've got Claude, etc. And each team is working on stuff that's adding value for them. We got the fixed interest team is using AI to spot pricing anomalies on the curve. We've got our private markets team that have come up with some reports using AI with some really interesting reports. We've got our liquidity management area that's looking at AI to estimate liquidity, etc. So these all make sense. And of course, we've got our portfolio managers that I guess that's the easiest application because stuff that used to take 3 hours, 4 hours when you're looking at researching a stock is now taking a fraction of that time. So in terms of stock research, that's an obvious application. So these are sort of things that are happening at the moment.
So in a sense, it's still at the point where it's a technology that is being applied to an existing process. It's not leading to process re-engineering just yet.
That's right.
Yeah.
That's right.
Can you see that day coming?
Oh, absolutely. But it has to be right. There's no point saying, it's 80% there. 80% there is not good enough, right? And at the moment, it's sort of 80% there. That means you've just got to run everything parallel. People are going to be checking it, etc. Because we're not going to send off a report to APRA that is 80% right. So it's there's still, but look, what we can't deny is the improvement that we're seeing. We're 6 months ago, that 80 was probably 40. Right? The question is whether we're going to continue that speed of improvement.
Yeah. Now you've mentioned the internalization of asset management, and you've mentioned the appointment of a new head of global equities. I think you said.
No, we a new global portfolio manager.
Sorry, a new global portfolio manager.
Yeah.
Let's not sack the
head
of global equities, right?
Yeah, head of equities.
Yeah, good. Sorry about that. So I want to talk to you about the advantages and the disadvantages as you see them of having management internalized. What's the upside for the organisation?
Our objectives were very clear at the outset in terms of internalisation. Firstly, what's really important is that we're only going to internalise strategies that we believe ex ante we could be competitive at delivering alpha with the external world. So, and that really kept us to what we call the heavy lifters. The plain vanilla type of strategies. Most Australian large cap strategies, Australian fixed interest, investment grade credit, etc. And that's absolutely fine. We're competing well with our external the counterparts. Where we're going to stay out of are the more niche strategies. Where even in Australia we haven't got a small cap team. We're not going to have an Asian strategy. We're not going to have a tech team or a high yield strategy. We're not even looking at developing our own private credit team. Okay, so we're very conscious about what we don't want to do. So what are the advantages? Firstly, there's a lot of tailoring that goes on. We've got a large defined benefit portfolio. It's about $40 billion. So we've managed that totally internally without any use of external consultants because we've been able to tailor strategies for that. Very specialized products. We've got an Australian dividend income product that we can manage true to label because we're doing it internally. So there's tailoring that goes on. The cost advantage is obvious, all right? So you just don't have that leakage. And when if you look at the fee structure in asset management, is wonderful if you can get it, asset-based fees. I'm not paying asset-based fees. So clearly, we're paying relatively fixed cost base. And so the operational leverage you've got of that is incredible. And when we took on Catholic Super, it was $13 billion fund acquisition. I did not have to add a single person to the team. So, and that benefit accrues all to our members. So, that's pretty obvious. We're much more closer to on the ESG front. We're not outsourcing ESG. It's my people, that are actually, engaging with our investee companies, et cetera, not through, we're not doing it through third parties. And finally, I think managing money internally makes you a better manager of managers as well. The nature of the engagement is more two-way. It's not the external manager spending an hour talking about his or her 3 favorite stocks. You're actually challenging each other. You're swapping ideas, et cetera.
Okay. Do you think you're a little tougher or on your internal strategies, or do you give them a bit of an easier ride compared to an external strategy, a manager running an equivalent external strategy?
I'd like to think we're very objective, okay? And also the decision is not just mine, right? We've got an investment committee. We've got, a really, really competent, experienced investment committee, people that have managed, asset management companies, et cetera, that we have to front up to once a year and go through as to why we can put our hand on the heart and keep running with these internal strategies. So it's not me that, that has to be convinced. It's also the investment committee. And on probably a dozen occasions, we've terminated a strategy.
Yeah, what has typically been the trigger in that case?
It's usually a change of environment, right? Rather than the person, managing it, et cetera. Or, the change of environment, we think, well, we had that strategy based on, our view of the, this is going to be environment. We went from a falling rate environment with, where, that suited a certain strategy. Now we're not. Now it's a higher, potentially rising rate environment. Let's close that, et cetera. As I said, rather than the alpha performance of the strategy itself.
So a question for you, John, from our partner on this podcast series, Robeco. Given that we are in a volatile geopolitical environment, what role do you see for quant in your portfolio management?
Look, it's really important. It always has been and always will be. Where it's most applied is in our global portfolios. Right? If you think about if we're running a pretty tight team, we've got and we're looking at large cap global portfolios. So we're not. Well, how do you actually get that into a manageable universe? You think about the thousands of global stocks that we have to try and get into a portfolio of 60, 70, 80. You can't do that without some sort of quant filtering process, right? So it's absolutely fundamental to our strategy.
Is that an area where maybe the application of AI is more likely than less likely?
Yeah. You can see it seems to be an obvious application for AI. The question, though, then is, does it all get commoditized? Right?
And where is the advantage that
that's
you're
right.
playing? Yeah.
Where will the advantage be? So if everyone, you've got a lot of these smart, quant people, around using the same LLMs, and you come up with roughly, you can get 10 factors, 20 factors, 50 factors, et cetera, load it up in your model, play around with algorithms, and, eventually, the advantage from the sophisticated quant is got to be priced out, you'd imagine, all right? Then where do you get your edge from?
Yeah, makes sense. So if you think back over the career that you've enjoyed, John, what would you suggest have been the biggest structural shifts in markets and economies that you've observed over that time?
I think the what I mentioned before, the absence of a true business cycle, where you say, well, you accept that slowdown, recessions are going to be inevitable, you position accordingly. Now, there's a chap by the name of Victor Chevets, I read, I really enjoy reading his stuff. He's a lateral thinker, et cetera, and his his fundamental sort of thesis is that the financial world is somewhere between 6 and 10 times the size of the real world. And we keep on talking about the real world, right? But the problem is we invest in the financial world. So I think, and that's really, it's influenced my thinking as well. And that's why sometimes you see, I think you see a much greater disconnect with what happens in the real economy and financial markets. So that's one big thing. The other big thing is, with the rise of, machine trading and algorithms, et cetera, you do see at a stock level, maybe a sector level, et cetera, these wild swings, okay, for small misses, on the upside or downside when stocks are reporting. Indexing is a huge difference. Indexing didn't really play that big a role, okay, early in my career, hardly any, and we got to accept that indexing is really pervasive, and that means that things can, at a fundamental level, things can look and stay mispriced for longer than you'd like it to.
Yeah,
right?
They can be good and bad.
It can be good, all right, because if you're long term, if you've got reasonably patient capital, you can actually ride that out.
Does it concern you at all that, given this idea of the death of the business cycle, which is an interesting idea, and a state of constant stimulation, as you've described it, there are investors growing up today, people who are managing other people's money, that haven't experienced the downside of being an investor. They haven't gone through a recession. They haven't gone through, well, some of them may have got through a GFC, I guess. But you've got a team potentially, or you've got individuals in the teams who have only ever managed money in this up and up and up environment. And, when the crunch comes, they're not going to know what to do.
Oh, I don't know. People are smart.
Well, that's what you're there for, right?
They work it out. And sometimes, the old, I don't want to be the old timer that says, hey, I'll live through this and I live through that, because, there are some old timers that, they haven't been in, they've been doing, the same, there's not 40 years experience, there's 1 year experience 40 times, so.
But perspective's got to count for something.
They do. Look, fundamentally, in a crisis, one thing that's common to all crises, because they're all different. They all have their permutations, different causes, etc. The only common thing is, you got to be liquid, right? And liquidity gets you through the other end, and gives you the chance to not only survive but to thrive as you take opportunities. So that's a common lesson, but you don't have to be an old timer to work that out.
I'm pretty sure it helps. The magazine the publication that I edit, John, is called Retirement Magazine. And this looks at the intersection of all the things that need to come together to help a member transition into retirement. Clearly, over time, more people are going to move into that phase. They're going to move into decumulation. What impact does that have on your role and the role of the investment team as more people move into that phase and start actually drawing down on what they're saving rather than building it up over time? Does it change what you do?
It's not impacting us right away, but we know the stats are, towards the end of this decade, certainly as we get into early in the next decade, the industry will be in net outflow because of this, the demographic challenge that we have. I think we've probably seen a peak exposure to illiquid assets, right? In terms of as a percentage, right? So, as we're growing, we'll allocate more. But I think, if you currently got a 25, 30% exposure, it's probably going to stay around there. I can't imagine that's going up, right? Because we've got to be mindful that,
so it'll just be the weight of money that drives that up rather than an increase in the percentage.
We've got, if you're looking at an infrastructure investment that you're going to be holding for 10 or 15 years, well, you could potentially be in outflow in 5 years. All right. So that's, a block of liquidity that you're tying up. So I think that's something that we've all got to be mindful.
And as you say, that wave is building. So is this something that's discussed actively inside the organisation?
Look, I think it will. Not so much that at the moment. it by itself, what's adding to this pressure, right, which I think is not discussed enough, or maybe I'm being overly paranoid, is the resurgence in retail, right? And we're seeing, the industry funds, we see the platforms are absolutely killing it, okay, in terms of the net flow, the Hub 24s, the net wealths, et cetera. And that's adding to, that's a near-term strain on liquidity. Now, it's not, industry funds, that's some competitive flows. Industry funds are still in net flow because obviously you've got your contributions, net contributions. But I think that's going to add to the stress, and maybe there'll be more discussion about liquidity constraints.
We've got payday super changes coming up. They kick off on the 1st of July. Contributions are going to be flowing in at the same time that wages are paid. The practical impact of that, I guess, is that there will be smaller but more frequent contributions coming into the fund. Does that change your liquidity management approach at all?
No, we won't. At the margin, but...
And why only at the margin?
Because it's just not big enough to impact what we do on a day-to-day basis. We've always got it. The current stock of liquidity we've got now would dwarf, the delta.
Right. Okay. Bit of a non-event in that sense. Yeah, got it. UniSuper's got a really interesting membership. It's based in academia. Those people are typically quite smart people and very engaged. How do you how much do you enjoy engaging with the members, and to what degree do they really hold you to account for what you do?
Look, firstly, we should clarify here. UniSuper is actually a much broader church than just academics. Even within the university sector, you've got academic staff and then you've got general staff. All right, so straight away, it's not just because someone's at a university doesn't mean they're an academic, okay? And, half of our flows now come from outside the university sector. We've been open for years now, so we're open to all Australians. So now, do we have a more engaged base? Yeah, definitely, but I would say it's only a very small cohort. Generally speaking, our members are really happy being UniSuper members, but clearly there's climate change is a big issue. Fossil fuel exposure was a big issue. It's not so much what's happening in Gaza, in the Middle East, is a big issue. I'm not sure that we get any more, activism, et cetera, than our peer funds, but we certainly get it.
If we just leave the Middle East to one side for a moment, themes such as climate change, fossil fuels and so on, are they themes that you think actually have investment merit, or are they themes that funds, whether you want to talk about UniSuper specifically or funds generally, pursue because of pressure from members?
I've always encouraged my team to not talk about climate change and talk about decarbonisation, right? Because then you've got an investment thesis, right? And we, just like we talk about, data center build out, AI investment, that's a big investment super cycle that is going to create lots of opportunities. Well, decarbonisation, is not talked about as much these days, right? Because we've got a lot else going on, but that's also a really pervasive investment thematic, right? And another super cycle, the energy transition. So yes, there is absolutely investment merit there.
No, you're right. That particular theme has been buried a little bit by the focus on the sort of active investment in AI, but it's still there, and it's still just
still there. Most countries have still got net zero aspirations, and even if you've got, say, the US pulling out of Paris, et cetera, talk to US corporates, okay? They're still getting on with it. So
decarbonisation, on the one hand, is a tricky theme to pursue when you've got the investment in AI accelerating at the pace that it's going, and the carbon footprint of the AI theme building up. On the other hand, so net, what does that look like?
Look, we're going to get to a situation, and we already have, where the hyperscalers and the data center, it's going to be a case of BYOG, right? Bring your own generation, and even if they are not bringing their own generation, they will be asked, okay, to pay the premium, right, if they're going to be accessing the grid. So I think that will net out. You're not going to have the policymakers allowing the data center owners and operators, all right, to access the grid at the expense of their constituents.
Okay, so just to wrap up, John, you've been in financial services for 3 or 4 decades, without wanting to put too fine a point on it. Over that time, what decisions have you made as an investor that you have been most, can I use the word proud of, that have paid off most handsomely, where you've gone afterwards, yeah, we got that right?
Yeah, look, we were early into the financial repression theme, right? So
Financial
repression.
Mm-hmm.
Okay, so post the GFC, when there's a great book written by Reinhardt and Rogoff. Okay, this time is different. Okay, where and if you follow that book, and basically said, look, rates are going to zero, and so you remember the rates. They went down, they went up, and said, look, and people figuring they're going back up to high single digits. And so we structured our portfolio very much, it was a big bet on rates were going to stay lower for longer, right? And so that was a bet that we were pretty proud of. We got onto the tech story pretty early. So once again, after the GFC, I had my guys going around the US looking for pure tech portfolios. They'd be getting out their flip charts and dusting it off, going, nobody's wanting to talk to us for, and so we just identified that as a really pervasive theme, okay, and we've just had a structural overweight to tech, which is we've got right, and now we can get on to what we've got wrong.
That was the next question. Again, you're asking the questions for me, but not just when were you wrong, but how do you know when you're wrong? At what point do you say, right, time to pull the pin on or pull the plug on this?
Well, there's no set formula, right? And look, we've been overweight Asia, right? Well, we're not now, but we were overweight Asia for too long. It wasn't too bad because we were underweight Europe, and Europe didn't perform that well. But look, we got to just admit when you're wrong. And at one stage, it was a really big overweight, and I think I have to own that decision. I came back from China, pretty excited what I was seeing in Asia, and just what I got wrong is it's all well and good having growing economies and growing middle class, etc. But if that does not convert into equity returns, well, it counts for nothing. Right, it really counts for nothing. And I overestimated the ability of these Asian-based companies to convert the growth tailwinds into equity returns. And that's why we like Japan at the moment, by the way, because we think for the first time the companies are in great shape, and they're becoming far more shareholder friendly.
You manage, or you're responsible for the stewardship of $170 billion of other people's.
It used to be a big number.
Yes,
we're not a big guy anymore.
Isn't that crazy?
Yeah.
But that's absolutely true. How heavily does that responsibility weigh on you? Like, if you and your team get things badly wrong, that has a material impact on the members that you serve.
Look, it is a big responsibility, but because I've grown up with it, since I was 30, I felt 30 was also a really big responsibility at the time, right? So it's not, you're not that conscious of it. Wow, you wake up because you've grown with the number always being a big number. You just accept that, it's a really responsible job. We have a set of 10 guiding principles that govern what we do in investments. And the first one, it sounds a bit corny and a bit motherhood, but it's superannuation equals life savings. So with that, that's sort of that responsibility is entrenched in us. I'd like to think, It's something that my successor will continue with because this is not just a pot of capital. This is people's life savings. Treat it that way.
Got it. John, we've talked for quite a lot longer than I expected that we would. Thanks for
Actually, there's going to be a lot of editing.
Thanks for being so generous with your time. Thank you for coming in. It's been terrific.
Absolute pleasure.